Our guest host this morning is Dan Gilbert. He's chairman and founder of Quicken Loans. He's also the owner of the NBA's Cleveland Cavaliers. And among the topics we are ready to talk about with Dan, the looming fiscal cliff, what's at risk for corporate America and the broader economy. First, though, we're going to mix things up and start with some of this morning's other top stories. By the way, Dan, welcome. It's great to have you here.
Great to be here.
We want to find out about a lot of things, including the housing market, because I know you've got a really good feel on these things.
There's a lot to talk about there, that's for sure.
Mm-hmm. And the cliff and also some of the stuff happening in Michigan as well, in Detroit. Anyway, Netflix received a Wells notice from SEC. Regulators warning that they may bring civil action against the company and Reed Hastings for violating public disclosure rules by posting something on Facebook. Back on July 3rd, the CEO posted, and here's the quote, Netflix monthly viewing exceeded 1 billion hours for the first time ever in June, which seems, he thought that was fairly innocuous, but the SEC says it violates Regulation FD, which is the public disclosure. You have to have make full and fair public disclosure of what would be considered material non-public information. And Hastings says this is crap. He's dismissing the SEC contention, saying he did not believe that the post was material on Facebook. In a letter yesterday, he also suggested that because the post was accessible to more than 244,000 subscribers to the page, it was very public. Shares of Netflix, not much happened after the bell, but there are other things happening with the company, too. We're going to talk to an analyst who covers Netflix in about 11 and a half minutes.
This is kind of a crazy story. I did find out it's a public page, so it's one of those where you don't have to be friended to get onto it. Anybody can look at it. Dan, you hear a situation like this, the SEC kind of breathing down his neck on something like this. Would it occur to you that was something?
Well, I'm just glad we're not a public company, because if my Twitter account ever got... well, I'd be in big trouble, So, yeah, he's just posting sort of, like you said, an innocuous statement, and... the whole world can get to it, so I don't know what the issue is.
That wasn't in the prompter. I threw that in myself, innocuous. So you think that's okay?
Innocuous, I
might be violating public disclosure by not...
Doesn't that sound like an oxymoron, just a sentence, right? He's posted on Facebook for not publicly disclosing something that he posted on Facebook.
Right.
It sounds like it contradicts itself in the very sentence, right?
That he publicly disclosed.
Yeah.
On Facebook.
Right.
That's right. Maybe it had to be on Twitter also.
I wonder, wouldn't you like the people involved at the SEC, just like the 4 or 5? Maybe they're, 26 years older. I mean, who are the people that decided? I'd like to ask them.
You would hope that, I think Becky said this in the last hour, you'd hope they have better things to do. Right. And I think we established earlier, if Reg FD fulfillment is telling a reporter who could have 25,000 readers,
if that's
and he has 220,000 potential readers, and it's 243, and it's public, then how could this be anything more than a public disclosure? And it's immaterial, right? I mean,
we talked about how if you talked to a newspaper that had 25,000 readers, that would be considered.
That would be considered fulfillment of your Reg FD of a public announcement.
I mean, is it overstating it to say the SEC should rise above in this case? Do you think?
I think that's clearly not overstating.
Get my pen. I'm going to find it. I haven't seen it in a while.
We'll get one for you.
All right.
Could a corporate bond bust be coming? Top-rated companies are on pace for a record year of debt raisings in the United States, with deals already topping $1 trillion in value. But the Wall Street Journal reports some of the biggest fund managers are warning dangers are lurking in what were once seen as the safest investments. Interest rates are low and bond prices are high. So some managers warn there is little room left for gains. Some worry even a small increase in interest rates could eat away at bond prices. Cautious U.S. Am I supposed to read that now? Cautious U.S. companies have been stockpiling cash, but numbers from the Fed yesterday showed some of these firms have slowed their savings as the economy has emerged from recession. Still, S&P's Howard Silverblatt says companies may no longer be adding to their cash reserves, but they aren't drawing them down either. Offsetting the fear of business uncertainty, some companies are, as we've discussed, issuing special dividends, trying to beat possible tax hikes next year. The fiscal cliff uncertainty could also lead to an increase in mergers and acquisitions as would-be sellers look to complete transactions by year end. And I made a fool of myself in the last hour trying to puzzle this through. Not doing it anymore.
We do that all the time here. That's what we have 3 hours
right,
for.
Exactly. Right. It was dumb.
Who made up the name Fiscal Cliff? Where did that actually come from?
I don't know.
Bernanke, maybe.
Really?
Maybe Bernanke?
That thing really stuck.
That's a good question. That's a good trivia. I'm gonna Google that.
We've had a lot of, we've said it's not really, it doesn't happen immediately, so it's more like a slope, a ski slope, and it's not really a black diamond slope. It's more like an advanced. I mean, we've parsed this to
like a double blue.
Yes, like a double blue, but now with a lot of moguls.
Right.
Yeah, we've done that, right?
Dan Gilbert is our guest host today. He is the owner of the NBA's Cleveland Cavaliers, the founder of Quicken Loans. And Dan, you're the perfect person to have here because you have your finger on so many different things that are happening in Detroit, around the country. Let's start with the housing industry this morning because people have been trying to figure out if the resurgence there is for real. You see so many people who are coming in either for mortgages or for refinancing. What do you see happening?
Well, real estate's local, as we all know, so it's a market by market thing. I mean, when you put a national number to it, you're really just taking an average. It's sort of meaningless if you think of it that way, because there's some markets that are doing well, and then there's some that are, or most of them are still fairly flat. I think we've got a little bit of a bump. I wouldn't by any means call it some kind of a major recovery yet, but we're seeing areas, in the West, you're seeing areas in the Midwest a little bit, not so much in the Northeast, a little bit in the South, they're starting to bump up a little bit.
You mean in terms of prices?
In terms of prices, yeah. And of course, you have the inventory, which I think peaked at 12 months, is now, down in the 5-month range. The average inventory, the average time a house stays on the market before it sells. So that's one indication. But by no means, you would think if somebody were to tell you, a few years ago, we'd have 3.25% interest rates, 15-year rate at 2.99. What's the housing market doing? You would think, it'd be booming, and it's certainly
people need to rush. Is there too much complacency? Because I think of all the smart corporations have floated a lot of long-term. I mean, these are rates that you would have dreamt about in the late 70s, early 80s, where it was 17% for a mortgage rate. I had to make a prediction of where rates would be at the end of 2013 for, Steve's mad. Was it you that was mad that he had to make a?
Yes, that was.
You're mad that the company wanted you to make a prediction. So I said that watching interest rates next year would be like watching
paint dry?
Grass dry or watching paint grow. Those were my two analogies. But Kramer thinks it could go significantly higher. I thought if Bernanke tells us where they're going to be, I thought we could believe him. Do people have time to have this once in a lifetime?
I do think there's some time. I mean, again, it seems to be that things have bottomed, right? If you look at housing prices, the inventory of homes, it looks like things have bottomed. So I think, you're certainly not hurting yourself by any means waiting for it to go lower, wait for rates to go lower, wait for housing prices to go lower. I think that it's definitely a good time to buy. I mean, to have a situation where you have the rates where you're at and housing prices where they're at. Usually they're opposite, right? They're inverted. So,
Dan, given what Joe just asked,
do you think rates can go up, Steve? Next year, do you think they could go?
I don't think they're going to go up next year.
Could
they? Absolutely, they could.
So
but I don't think it's likely. Yeah, but I don't think it's likely. I think the Fed's going to be taking too much paper off.
Because the economy's still going to be so weak, right?
The economy will be weak. You could have an increase, but you could also have margin compression, which is what I wanted to ask Dan about. On the surface, if you don't understand how you fund your loans,
right?
It looks stupid to give somebody a 30-year loan at, what are we talking about? 3.5, 3.4 in some places.
Right.
But Joe's suggesting interest rates could rise. But that doesn't really get into how you fund yourself.
Right.
Is it dumb for a mortgage company to make a loan of 3.5?
Well, most mortgage companies and even banks, eventually are taking that risk off the table by selling those loans in the secondary market, and they're pulled and securitized.
So who's buying them? Who's like the dumb money?
Well, the Fed, as you know, is buying.
The Fed's buying
out of it. And you still have these pension funds, and you still have insurance companies, and you still have worldwide international buyers, right, that are buying this stuff.
That is. So we are.
Yeah.
We are.
Yeah. I mean, they average though.
Dumb money.
It averages about 7 years, six and a half or 7 years, right? Even though it's 30 years.
Right.
I mean, the average duration before people pay off, move or refinance. But of course, as rates, the lower they go, the longer these mortgages are going to last theoretically, because people, especially if rates go up, because people won't be incented.
The duration.
What seems crazy is the Fed recently has kind of indicated they would like to see rates go even lower, right?
I have said publicly that a Fed member was opining with me about a 2% mortgage. I don't know if it can go that low, but the conversation was something along the lines of, I said they're really low. Could they go any lower? I said, well, what do you think would happen if mortgage rates were 2% or high, in the 2% range?
It's hard for me to imagine.
Is that possible, Dan?
I certainly think it is. Now I believe anything's possible, because 2 years ago, if you would have said you're going to see a 15-year at 2.99, which it is this morning, I would have said you're on some kind of drug or something. So, anything's possible. But will it really help the housing market, if it's not sparking it at 3.5, 2.99, it's 2.5. Is that really the reason? I don't think that's the reason. I think Joe referred to it earlier, the economy and jobs. I mean, I think job security drives it more than anything.
My argument has been, and I'm happy to change this, that it may not be the answer, but it's part of the solution and it helps a bit. But the important question on the other side of that, is it doing harm?
Well, I don't know how it would do harm unless you started looking at bubble situations again, like we had in the 05.
But there's no bubble.
Yeah, I don't know what's an inverted bubble. I don't know what you would call that. But yeah, we're nowhere near anything like that, right? We're not even at historical sort of average rates of.
Right. I guess the harm could be the Fed is growing its balance sheet too high, and it's going to have to eventually sell them. But I think the Fed can hold on to those mortgages, let them trail. It doesn't have to do harm by selling them into the market at the time. The other harm that's been mentioned is it's ruining the normal functioning of the market.
Yeah.
The other harm, I guess, that's out there is the Fed is forcing people into other riskier assets. They can't sit on the mortgages anymore. Right. They got to go other places where they shouldn't be.
But it looks like cash is still very, very scared and on the sidelines in everything, right? You have cash in banks at an all-time high, so it's never been, this high before. And you do have some appetite for borrowing, but not like anywhere near it was. And I always wondered, what's the policy that's going to shift the cash on the bank's balance sheets into the economy? I don't know if raising the capital gains rate is going to do that, but there's got to be something that the banks eventually do with it.
What does someone need at this point? Because the other big criticism has been the people who really could use some mortgage relief, some rate relief in terms of what they're paying, can't get access to the credit. What does someone need at this point to go to Quicken Loans and be able to refinance their mortgage?
Well, there's sort of two worlds going on at once right now. You have the HARP world, which is the federal program that says if your loan was originated before June of 2009 or earlier, and that loan was securitized and guaranteed by Freddie or Fannie right now, there would be no look at the value of the home currently if your payments are on time. And a lot of people don't know that.
I didn't know that.
And believe it or not, you can go up to 200% loan to value or even higher. There's no loan to value limit. So if anybody's underwater today, and this is a shocking thing, I'll tell you right now.
When did this happen?
Oh, well, it's happened over the last 6 months, but there's been a year even. There's been a few changes, and even loosening of that. Now, here's the thing that'll shock you. We're pretty good. Our company, Quicken Loans, is pretty good at getting a hold of the consumer. We like to pride ourselves on that, right? Only 1 out of 4 homeowners that we have the information on that says you'll qualify for this HARP loan, who's underwater and whose rate right now is much higher than the market.
6s and 7s.
Well, your 6s, 7s, 5s. Right. We only do 1 out of 4. 3 out of 4 we can't either convince to get a hold of, or they don't believe us.
I didn't know that either. I mean, we talk about this all the time. And this is something that's changed in the last 6 months. Maybe you went before and tried to get refinanced, but the assessment came in at the wrong level. So if you were one of those people, you should go back and try again?
Absolutely. There is a boatload of consumers. I mean, a boatload out there. Tens of millions right now who doesn't believe that they can refinance. They're making their payments on time. So for Fannie's and Freddie's standpoint too, it's a win-win.
Conforming mortgage, current on payments, a loan to value up to 200%.
Oh, no, it can go higher than that even in some cases. So it's not.
Do you even need an assessment?
You don't need an appraisal in most of them. I mean, you do a quick look at value just to have it, but you don't really need one. And again, this is if the loan was guaranteed by Fannie and Freddie. So there's a lot of loans out there.
And it happened before June of 2009.
June of 2009 is when or earlier. Yeah. So.
Well, Dan, what's your phone number?
You want to call him? We got a lot to talk. USA Today, Pete, I want to ask you about all the Cavs have guns. I mean, all these athletes, man. Anybody who's become a target has a gun, basically. Did you see this? USA Today?
No, I didn't
pay 70% of NFL guys that make some serious money. People know where they live. For protection, they buy a gun. Yeah. So, I don't know. You don't know?
Can you ask him about the
net? Do I? Yes. But not with me right now.